these final moments. Liz Young, to you first. To the Bears. Throw caution to the I didn't say you. Throw caution to the wind now or what?
First of all, I'm excited to be in the market zone. I never get to do this.
All right, well, welcome.
Don't blow it.
I think you can throw caution to the wind for a little while. Things changed today, and Gunlock used the word pivot. We moved to a different part of the conversation, right? We went from, they were talking about maybe hiking. Now they've basically declared that's over. We're talking about considering when we should be able to cut. Now, the idea of the market pulling cuts forward, though, I think is precarious, right? We continue to pull them forward. We don't have a lot of time between now and March, and the Fed likes to foreshadow things really far in the future. First we talk about cutting, then we actually cut, right? So they need a little more time than that. I think pulling it forward is dangerous. The other thing that I know I've mentioned on this program is that the period between the last hike and the first cut is usually okay. So I think you can, for the time being, jump into this rally, let it run, let the clock run on it. But as soon as that first cut comes into view, you get more nervous.
Mike, save for a cut happening today, this was about as dovish as the bulls could have ever hoped for, right?
I think it was high hopes exceeded, because I think we really did expect more or less a nuanced type of pivot, and it was much more explicit. You didn't have to read between the lines. He didn't throw out as many of the typical disclaimers of saying, don't really look at the dots. They don't mean anything.
As I said,
that's what he sometimes does.
He didn't hawk it up.
That's right.
To walk back anything from the statement.
Right. Now, that being said, and of course, you mentioned the Dow. The S&P is within 3% of its record high. It's pretty rare you get within 3% of the record high. You don't at least make a run at it over the next couple of months and maybe hit it. So all the things moving in the right direction. A lot of technical repair in this market. The Fed is now no longer pushing against it. We got confirmation, too, of a couple of things I'm trying to look at, which is the Fed is not really targeting market levels. It's not looking for bank shots of trying to influence financial conditions this way to get inflation to do what it wants. It cares about inflation. It's the only thing that matters. So therefore, the atmospherics around it, they don't have to look at job openings anymore. It's all about the inflation numbers. That being said, so much has worked in favor of this market in the last 2.5 months that you have to start to sit back and say how much is left. You had the soft landing celebration rally. You had the rate relief rally in banks. You had kind of the low quality, heavily shorted garbage that got washed out. And you had a repositioning rally because people didn't own enough stocks. A lot of that's different right now. So I think you have to be at least cognizant of the idea that it's everybody can clap and say we did it, and it's a culmination type moment, and then figure out what it takes from here. And maybe a 4% nominal GDP economy next year, if we're lucky and everything comes through. It's a different tone than what we've been dealing with recently.
I mean, Josh, he had a chance today to express any sort of concern or worry that financial conditions have loosened, given, the 10-year's down 100 basis points in 6 weeks, and stocks are up an awful lot in 6 weeks. And he really didn't do that either, to Mike's point, that they are, if this doesn't tell you that inflation is the only game in town, then nothing ever will.
Well, he also has to be intellectually consistent. So if we're saying during the tightening cycle that it operates on a lag, then let's also say that cutting rate, the risk of cutting rates is probably not an immediate risk of things getting too loose, because that operates on a lag as well. At least that's how I would choose to see it. I'm curious from you guys, the 2-year, we talk a lot about the 10-year, the 2-year down 30 basis points today, 4.45. Is it down enough?
Well, a one-day move in the 2-year, first of all, you look at that chart and take the title off of it, you'd think that was some kind of small cap.
Looks like Snapchat after it reported earnings.
Right. So, first of all, just volatility that big in the Treasury market is not a comforting sign to me. Is it down enough in one day? I think that's plenty in one day. I think over the course of the first quarter of 2024, it's going to come down considerably more, especially if we expect rates to be cut starting in March. But then what that means is the yield curve uninverts, right?
Yeah.
Then you've got a re-steepened yield curve, which might be good for things like financials. And again, you've talked about the valuations, I think, earlier in the show. That might be a good time to start towing into something like financials. But an uninverting yield curve at the beginning of cuts is usually a dangerous time for markets.
Mike, the top 2 performing sectors, utilities, number 2, XLRE, S&P real estate, number 1. Not a shock to me. Is anything about that surprising?
No, pure
textbook, right?
Yes.